You're watching Stock Watch this week. I'm Ndawling Lechela, and joining me to unpack your stock-related questions today via Zoom is Louw from PSG Wealth and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for joining us this afternoon. Let's kick things off with general markets action. Cobus, trade has been choppy in the US. We saw, that Moody's downgrade coming towards the end of last week. Treasury also in this, or Treasury yields rather, also in the spotlight as lawmakers mull that tax bill. Take me through just your analysis of trade this week.
This has been the most difficult trading week for US markets since the tariff tantrum. We're seeing a little bit of calm robustness returning to the market today. A relief rally in both treasuries and equities, pretty broad base. So we'll see some of those losses claw their way back. The dollar remains on the back foot, though.
Yeah.
I believe that's even weaker against the basket than it was earlier in the week. So I suppose the market is trying to digest this, this new paradigm. Eventually these policies are going to translate into real numbers. Naturally, we haven't seen that yet, but the Trump administration is certainly set on forcing this rebalance. Their methods have been a bit wild, but I suppose the goal could be rationalized somewhat. And the market has yet to see how it should price all of these movements. So absolutely interesting times. But having said that, given the expectations of we had probably had for the South African outcome about a week ago, we are looking significantly more robust. CPI is printing low. The outcome of the White House meeting was better than expected, or less disastrous than expected. And the economists are trickling in with their expectations for the rates decision next week, and the majority of them are anticipating a cut, which is quite positive. I believe of the 12 surveyed by Bloomberg, 10 have indicated a 25 basis point cut now. So altogether a little bit more rosy this side from both an equity and a fixed income perspective.
So as you mentioned, tough times for U.S. equities, but we are seeing somewhat of a rotation outside of the U.S. We are seeing some rotation coming through to Asia, some through to emerging markets, and some through to Europe. Skalk, let's get your take on how markets performed. Cobus, they mentioned how resilient our JSE has been. The rand also pretty strong. Of course, this on the back of a weaker dollar. We are trading under that 18 rand mark at the moment.
Yeah, good afternoon. Let's put that in numbers. What Cobus just told us, very, very resilient. Actual numbers, as we sit here, yesterday's close JSE all share up 12.5%. Today, another 80 basis points. So that's over 13% year to date. If you told me in the beginning of the year, as we went into 2025, that we will be getting 30% for the full year, I would say, where can I sign? But we're sitting here in May. How does the saying go? Sell in May and go away. Let's hope this year it's not the case, and let's say we can continue on this. 215 versus 214. The House of Representatives, when they actually had to go and vote on President Trump's big, beautiful tax bills. That is passed. That's literally just one person voting for the tax bills, and that's, I think, is going to have a massive effect on the US. Again, looking at numbers, that should add close to another $6 trillion in US debt, and when we look at the deficit, would most probably for the remainder of the year put another 600 billion dollar deficit towards the US. So yeah, as Cobus mentioned, the credit market not looking good. Bonds, I mean, really trading at the weakest yield levels that we've seen this year. I mean, pretty much putting us back to last year, or let's call it prior to where the Fed decided to pivot, which was the end of 2023. I'm a little bit worried, as I would say, I'm a little bit worried as I'm sitting here.
Let's get into some questions. Now, there's a question here on Sibanye asking if the panel can discuss the group's prospects on the short term, or rather in the short term. Cobus, I'll give that to you.
Maybe I'll hand that off. You know how much I like these resources stocks.
Yeah.
I think Skulk is a gold bug, right? They have some gold still. Maybe he should take that one.
All right, Skulk, let's hear from you.
Nice hospital pass there. Thanks, Cobus. I will definitely cover this one. Yeah, I think, as Cobus mentioned, they still got some gold. I think, if I recollect, the total gold within the EBITDA makes up about 6 or 7%. So very, very little. I think they wish it was a little more, more, a PGM company as we sit here. And we've seen this week, a bit of a movement back towards the platinum stocks, the palladium and platinum stocks.
Yeah.
We know it's been the London Platinum Week, and the feedback that we've got this week is that people are getting more and more upbeat. We see that the import data from China shows that the definitely demand is picking up. And I think this whole thing around PGMs being under pressure and the whole world is going to move towards electric vehicles overnight, they suddenly realize, no, there's a thing called hybrid, and the hybrid market is picking up, and they actually need more PGM. So I think we've seen the movement there, and I think this could be very, very, very good for something like a Sibanye, dabbling in both PGMs and naturally, as Cobus said, gold.
And I'm looking at, the top 5 major moves or movers on the JSE at the moment, and it is those PGM counters. Implats leading the gain, Anglo Plat, Sibanye, Northern Plat, as well as Anglo Gold in that mix. Just your thoughts then around, buying into those platinum shares at this moment, Skulk?
Yeah, I think that they've been fairly under pressure. I mean, we know that the likes of the Impalas, Amplat's got a bit of a different story. And there's talks of a bit of an overhang when Anglo-American eventually get rid of the Amplats. So there's a bit of a different story, but I think the platinums or the white metals in general is looking good. Remember, there's still the sanctions in Russia. We still very much got that in play. And as a South African producer, I mean, we're the largest producer of palladium in the world and second largest of platinum, largest in rhodium. So this bodes well for not only for our platinum counters, but also for our economy. So yeah, short answer, I'm carefully bullish, carefully optimistic currently looking at our PGM counters.
All right, Cobus, let's get into Sasol. This one is a fave here on Stockwatch. The group also had a capital markets day earlier this week, unveiling some turnaround measures. Markets seem to have liked the news as we saw that share price tick higher on that day. The viewer asks if they should buy or wait at these levels.
Yes, look, I mean, this was long expected, and the market obviously received the strategy quite positively. I read one or two analysts, commenting that the path to coal production wasn't that well established, wasn't that well communicated, and that's of course one of the major bottlenecks for Sasol's prices. As if they hate Sasol, the very next day, we received the news that OPEC Plus likely intends to increase production by 441,000 barrels a day in July, which again puts some pressure on Sasol subsequent to that rally, but it's still up nicely. Absolutely, something needs to be done, but I think there's significant execution risk and perhaps a bit of a lack of credibility for this management team.
Yeah.
And they, as a turnaround play, yes, perhaps it's worth a flatter, in terms of that sort of structural discount unlock that one could expect, but ultimately as a play on the energy sector as a whole, they are much nicer stocks to hold than Sasol, and it's not it's not an attractive investment in a total portfolio context at all. There's simply too much execution risk, and it's not just on the petroleum side. Of course, the chemical side, there's complete oversupply in that market, which is not going away anytime soon. And so sort of from both sides, finding themselves on the back foot, finding themselves underinvested and outmoded precisely when all the commodities they produce are effectively under pressure. That's not a great situation for them. So no, I'm not too fond of the stock, even though I do see the merits in a bit of a turnaround play hypothesis.
And Scott, what about you? Are you backing CEO Simon Baloyi and those turnaround efforts?
Yeah, I think, there's definitely, as Cobus mentioned, they're not without their risks. And it's a definite uphill battle. I mean, they're sitting with serious debt levels now, given they've really managed to bring that down. And in this, as capital markets, they've already mentioned that they're going to target, bringing this let's call it their net debt levels down to $3 billion. And I think the biggest worry for me, and I think that's just to add to what Cobus has said, President Trump has made it clear he needs to get inflation under control, like ASAP. And yes, I know that people will argue, well, but look, what about we're sitting at U.S. inflation rates lowest levels since February 2021? What are you talking about, Scott? But remember, the whole tariff, is very much still in play, and most of the economists and analysts wants that it will have an inflationary effect. So why am I mentioning that? Sasol, as we sit here, they've got a nominal break-even oil price currently as $58 per barrel, and we know that looking at the current oil price, and as Cobus mentioned, more supply coming towards the market could put some further pressure on this oil price, or let's call it move the oil price down. They did mention in this capital markets day that the further plan is also to actually decrease to lower the nominal break-even price to $50 per barrel. So I thought that the forecast was looking good. I think they've got a few plans, and now just to execute them. Should they execute them? Can they execute them? Most analysts got it once that they've got a bit of upside in this share price.
I have something here on paper and pulp, and the viewer is asking between Sappi and Mondi, which is better. I'll kick things off with you, Cobus.
I guess I like both, to be honest. These shares have been under severe pressure. Do I have a preference? Probably Mondi. It's this is again one of those businesses that I would say it's a terrible business with an excellent management team, and guys seem to be able to execute in the market. They of course had their headwinds in the wake of the war in Ukraine and the subsequent divestment from the Russian operations, but and we've seen severe pressure on the output, the commodities, the corrugated paper in particular, which was hurting them, and we slowly seem to be seeing a bit of alleviation in that, them being able to push down increased price increases to the end customers. It's one of those situations, I think, very similar to the PGM cycle, where there's a bit of overinvestment in production, and subsequently, as you allow demand to catch up to that, and of course, once those prices have come off, the industry stops investing as aggressively, and then that supply demand mismatch shifts to the opposite side. So from this level, we do like Mondi. It has recovered a little bit from its previous pressure, but there should be significant upside if we see those prices recover well into the next 12 months.
Skull, do you share the same views, Mondi over Sappi?
Hell, I never made money out of Sappi ever in my life, and you can see a few grey out of me. So I'm going to be the first to say I'm not touching Sappi ever again. No, I'm just joking. Mondi definitely. I think Mondi well diversified. As Cobus mentioned, they divested, from Russia. It was a bit of a worry back then. They recently made that acquisition there in Germany, where they've got a plant there. So, why I like the likes of a Mondi is a very defensive type of play. And I think, and as I mentioned earlier in this conversation, I'm a little bit worried of current levels. We've had that massive retracement in markets in general in the beginning of April, and for good reason. I mean, we've got the whole tariff play that's got a massive, not only question mark on it, but definitely, as I mentioned, a possible inflationary effect on the globe. And that had a massive retracement in the markets in general. Now, since then, we've pretty much made up all of those losses again and surplus. And as we sit here, I'm a little bit worried with the market, and why I do like at the likes of the Mondi. And I can actually say that I'm not invested in Mondi, but it's a company that I do like because I do think it's got massive defensive qualities. They make these boxes which get food delivered and products delivered. Things that will never stop, even if we go into a massive recession. So, yeah, in general, I like Mondi, and I prefer Mondi above the Sappi.
All right, Scott, I'll stick with you. Next question is on Nampak. What's the panel's view on the counter? They've been, in a turnaround phase for a while now, disposing of all those non-core assets under the leadership of Phil Louw. And today's results, not too bad. I think earnings were up 5%.
Yeah, I mean, there's a big but, on that, 5%. So let's start with let's make this a Chinese dish, sweet and sour. I mean, the sweet is, as you mentioned, earnings up 5%, revenue increased 11%. So things in general looking way better. I mean, this is a company that's been under pressure. To put this earnings in perspective, this 5% is basically earnings that increased from 448 million to 471 million. So about a 30 million rand increase. But there's fine print where they mention that within this financial year they had quite a solid pension fund surplus, of 65 million rand, and then also a very, very big point, they had that outstanding COVID insurance settlement that also paid out. That was another 100 million rand. So I would have loved to see this results or the earnings, excluding this let's call it 165 million windfall. They always have windfalls. Let's make no mistake. There's always windfalls every single year, but fairly flat.
All right, let's get your take, Cobus. What do you see value in Nampak? Would you be nibbling on that counter at these levels?
It's still, it's reasonably cheap.
Okay.
And the new management team is certainly doing a good job. I like it. I certainly do like it. By its nature, it's a capital intensive business, but if it's well managed, they can deliver well. I find it amusing that all of these, I don't want to come in too aggressively on historics, but all of these non-core businesses, which were the core strategies, frankly, under the previous management team, all of those businesses being disposed of at enormous losses. That's, I guess that's quite tragic in the nature of management teams trying to build empires outside of their core skills. But I think, it's been a decent enough turnaround play. Somewhat surprisingly, it was very distressed at some stage. But there's certainly more upside in it still, I believe.
All right, let's move over to the tobacco industry. And Cobus, I'll stick with you. Your take on British American tobacco.
I always say, and I guess this doesn't bode well for ESG from our perspective, but the first share we buy when we will launch a new fund is British American tobacco. It's absolutely at a sunset. But the nice thing about sunset is you no longer need to invest heavily, and essentially the business becomes a money printer. But that does diminish over time. Of course, those enormous growth numbers you saw when the business was less mature don't recur, but ultimately you buy this almost for yield. You buy it for the fact that it is enormously cash generative. And more recently, of course, we've had some regulatory tailwinds as opposed to all of the headwinds. Enormous deregulation in health and environmental regulation in the US specifically, which seems to be a little bit of a global trend. That previous pushback alleviating somewhat. Somehow vaping still not becoming regulated in many markets despite being mainstream, where they have, of course, tried to diversify the income stream and invested aggressively. So it's still at a very attractive yield. It's a nice stock to hold. From my perspective, it should be a cornerstone in any portfolio.
All right, let's move over to the poultry industry. I'll give you a different question, Skalk. What are your thoughts around Quantum Food? They were also out with results today. I think profits tripled. Is it a good buy at these levels?
Yeah, it's a struggle to buy it because I know if you read the media lately, you can see there's a bit of infighting. I'm going to say a bit. I'm putting it really mildly because there's two parties at each other, and I think both the parties own very close to half the company anyway. So trying to buy, good luck. I don't think it's one of those companies that's really investable, not just tradable. HEPS up 234%. I mean, wow! You look at that and you say, great results. But remember, they came out of a perfect storm. 2023. They had the whole bird flu, and they mentioned how load shedding impacted them. And then suddenly it turned around. We had no load shedding, and we had egg prices. Egg prices that tripled. Went from something like $3 per dozen to $9 per dozen. Naturally, really good for the likes of the Quantum. So yeah, I wouldn't read too much in the growth, but as I mentioned, solid set of results, great company, and but unfortunately, I don't think you're going to be able to trade it.
All right, let's get into your stock picks. Where are you seeing opportunity at the moment, Cobus?
Going to be boring today.
Okay, it's fine.
Choose Absa. Tying in somewhat with what we mentioned earlier about interest rate expectations, Absa gets less of that endowment effect. As interest rates increase, we see banks being able to lend at a bigger spread to their borrowing rate typically, and Absa benefits less from that. They are hedged, but the converse of that is that they are well positioned when interest rates get cut relative to the other banks in particular. We believe the sector in general, with the exception of Capitec, have languished somewhat. They are incredibly cheap, and Absa in particular. One of my first boss had a filter set on Bloomberg for stocks for situations where the dividend yield would cross the PE ratio, and that would either be indicative of a company going bankrupt or an enormous buying opportunity. And in this instance, we believe for Absa it's an enormous buying opportunity. The stock is very cheap. And another little tailwind, which doesn't get much airtime. Part of the reason they had disappointing results 18 months ago was devaluation and an effective IMF bailout restructuring within Ghana. Ghana being one of their two largest ex-South Africa markets, together with Kenya. And that market has turned around enormously, mostly because of gold. Ghana being an enormous gold exporter, generating significant foreign reserves, exceeding those IMF targets in terms of timeline, and the cedi has appreciated enormously. So we should see some sort of a correction there, some of those currency losses turning around and improving in Absa's next set of results, which I don't think the market is quite cottoned onto, and that in addition to the local tailwinds, we believe will lead to a good set of results and hopefully a bit of a re-rating.
And what about you, Skalk? Where are you seeing opportunity?
Cobus taunted me earlier, and I'm not going to disappoint him at all. I am going for gold. Yeah, Goldfields. Yeah, I know a lot of people tell me, all the easy money has been made. Goldfields really done extremely well, like most of these other counters. But thematically, I mean, look at the environment we're currently sitting. We're sitting with an environment where there's major worries about the US debt levels. There's worries of possible recessions, even stagflation. We know that all those are very much in play. And when I look at this, I'm not going to really go out there and say, well, the gold price are going to go to $4,000 per ounce or $5,000. I'm just stating that even if the gold price remain at current levels, a mine like Goldfields are extremely cash flow positive. And let's put that just in data and figures. As we sit here, they came up with the operational update, I think a week or two ago, and they mentioned, they all in cost for the past 12 months, or currently, is below what it was exactly a year ago, which is $1,861 per ounce. And I think the all-in sustainable cost, $1,625 per ounce. So even if the gold price stay at these, let's call it $3,000, $3,300 levels, these Goldfields are going to do extremely well. I don't foresee the geopolitical environment changing anytime soon. I do think that the uncertainty, the volatility, and definitely this economic worries that we're currently seeing is going to be sort of a main theme for the next 12 months. And while I'm doing that, I still am very easy and very at peace with having some Goldfields in my portfolio. People will say, well, it's maybe a bit on the rich side. I mean, some of the technical analysts will say maybe on the overboard scenario. Then again, the most of the trend followers will say, make the trend your friend.
All right, gents, thanks so much for your time this afternoon. That was Louw from PSG Wealth and Cobus Potgieter from Southern Cross Capital. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming through. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.